Hey there, class. It's Phil McDowell, a mortgage professor, coming to you again. And in the last couple of days, I've been getting applications from folks that are self-employed, and they're saying, Phil, I don't understand. I went to my bank, and in years past, no problem at all. I tell them how much I'd make. They'd write it down. They'd say, good, you're good to go. Now they want to have 3 years worth of my personal tax returns. They want my company statements, a whole raft of information. Well, welcome back to the future. That's the way mortgages used to be at least 7 years ago, before they brought in some of these alternate income assessments. Now, unless you're an accountant, you probably take a look at your business and saying, hey, how much business am I getting? That's the object of my wealth. If I can bring the money in, I'm good to go. So a lot of you are taking a look and saying, hey, I had great sales last year considering the recession. Like, I made over $250,000. How come I can't qualify for a measly $500,000 mortgage? What the heck is going on here? Well, what it is that they are starting to lend money both on the insured side and the conventional side based on not what your gross is. Gross is your sales. But they're also saying, hey, just because the money is coming in the door, is it pouring out the door just as fast? So here's what you have to take a look at. You take a look at your statement of business activities if you're a proprietor, and if you are in a company, you're going to take a look at something called your income statement. And the big thing is, gross is your sales. That's that $250,000, the $700,000, the $1.5 million that you brought checks in and deposited. However, what happens is you start Xing out some of those zeros, because those dollars turn into cents because of the money that you're pulling in. You're dishing it out. If you're giving it to subcontractors, if you're giving it to material suppliers, if you're paying rent, if you're paying for communications, the cell phones, the faxes, all that good stuff, internet connection, all of those things, X down those sale dollars until you get to something called a net. And the net, my friends, is what nets you a mortgage. So if you're not sure, what I would recommend doing is getting in, seeing the mortgage professor, and let's determine if there's something in here that you've got more control of, that we might be able to make an argument to say that that house that you want to get, you can pay for. Because part of the expenses may be something called discretionary spending. And that, come to the professor for, and we'll see how much discretionary spending you actually got.